If we sum up the first half of the Australian real estate market in 2023 with the phrase, it would undoubtedly be hitting bottom and rebounding. Beginning in March, the nationwide housing market in Australia terminated its 9-month decline, entering a recovery phase. As expected, Sydney is again leading the way, with a cumulative growth of 6.5% since the start of the year, compared to a national average increase of 3.4%. The clearance rate at auctions also skyrocketed from 61.9% in February to 74.5%. The current price of homes in Sydney is increasing by $4,262 a week. I remember the last time we spoke about such a trend, it was back in February 2021. Over the past 3 years, the Australian real estate market has experienced 2 significant boom-bust cycles, radically altering people's view of property investment. Those who once believed that the real estate market would never fall have changed their views. Likewise, the doomsayers who thought the housing market would never recover once it started to fall have been quiet. So in this episode, we'll look at what happened in the first half of 2023 and how the market reversal occurred. We'll examine what happened each month and the real estate investment lessons we can learn from the market changes. What can we expect from the second half of 2023 for the Australian housing market? Will it continue to skyrocket or gradually cool down? Towards the end of this video, I will present the viewpoint of Australian housing strategy on what fundamentally drives the rise and fall of the real estate market. And this will help you see through the overwhelming amount of promotional material and make informed decisions. Hi there, my name is Alex. Welcome to my channel, where I share information about real estate investment, economic trends, and wealth creation. If you like this video, smash the subscribe button and turn on the notification bell to watch new weekly videos. Without further ado, let's get into it. For investors, the first half of 2023 was an emotional roller coaster. Just as everyone returned from Christmas and New Year, the enthusiasm to buy houses and observe the market was still low. At that time, the Australian real estate market was still declining, with a drop of 1% across Australia for the month. However, many experienced property investors had already prepared their loans. They were actively looking for suitable properties on the market. And at the same time, most buyers were still disappointed with the performance of the Australian property market. Because of the interest rate rise, sellers were willing to accept lower bids in a declining market. It was a complete buyer's market where the buyer had the final say, and the bank's cash rate was only at 3.1%. Having been through several market cycles, these seasoned investors knew how to interpret market trends and ignore all the noises, such as news, real estate agents, and friends' advice. At the same time, other buyers are looking for properties to live in. Those people had limited budgets and could only buy better houses when the market was down and competition was low. People buying their homes won't sell quickly, so even though the market is still falling, they see better entry prices, not the market decline or worries about the future trend. Remember a property investment rule: the rebound from the market bottom starts with the entry of buyers of owner-occupied properties. Of course, we took action earlier than that. Starting November 2022, we have been setting up real estate investment plans for our VIP members across Australia and began actively looking for investment properties in the market. According to the data analysis, the overall market decline trend slowed down between October and November 2022. The market was still falling then, but the speed slowed, indicating that the market rebound was not far away. It is very difficult and risky to time the market, and it is not recommended for most home buyers. But if you're a seasoned investor, you see opportunities when others see risks. Remember that the risk always lies with you, not the market. The market became more interesting in February. With the high-end property market exceptionally hot, we began to hear more cases where properties were sold significantly higher than the reserve price in auctions. This reflects another investment rule that I always talk about. The property bull market begins with the high-end property market boom. More and more property investors are waking up and entering the market to buy houses. However, most people still ignore external market signals by habit, unwilling to accept that the market has started to improve, burying their heads in the sand and pretending that everything is calm and peaceful. In February, Sydney's property market rebounded 0.3% for the first time after falling for 13 consecutive months. The signal of Australia's property market in March was already very clear. Sydney led the way with a rise of 1.4%, followed by Melbourne and Brisbane. By the end of March, we had completed our VIP members' investment portfolio review, which lasted 4 months from November 2022. All VIP members received advice to optimize their investment portfolio. We helped members sell unprofitable properties, raise rents to the market level, set mortgage repayment floor, refinance, and buy suitable properties. At the company's front end, I could finally take a break after fulfilling the expectations of our VIP members. And the following few months are when most investors react, start to prepare for loans, and find houses. Much property market taught us if someone disagrees with you, it may not be that they are wrong, it may be that you are wrong. On 5th of April, something significant happened. The RBA paused the interest rate hike in the meeting, keeping the cash rate at 3.6%. I'm not exaggerating. The pause decision was made at 2:30 p.m., and by 3 o'clock, the news had flooded the social media. Everyone who had some connection with the property market went crazy. Those property investors buried their heads in the sand had finally changed their minds. They're thinking, oh, it seems that the market has really changed. Maybe we should start preparing to buy a house. The auction clearance rate did not disappoint. It went from just over 60% at the end of March to over 70% in the first week after the announcement of the interest rate pause. And by this time, the bearish investors started to turn bullish. Economists from various banks appeared on the news again to predict how much the property market would rise this year, completely ignoring that they had been predicting multiple times a 20% to 40% market drop for the past few months. So what we learned in April was the media, bank, and agents' views on the property market are all noises. Experienced investors never listen. Those who listen bought or sold at the wrong time for the wrong price or missed opportunities. In the same month, we observed a large number of immigrants and students returning to Australia, putting pressure on the Australian rental and sales market. If there are not enough rental properties, prices have to rise. Same in the sales market. And this is one of the two fundamental reasons the property price goes up. We will discuss this in detail shortly in this video. In May, the central bank chose to raise interest rate again. Many people who had been bearish for a long time started to cheer. They go, look, interest rates are up again. The Australian housing market can't go higher. Well, the result went completely the opposite direction. The Australian housing market rose by 1.2% in May, with every city rising. Sydney is in the lead with a 1.8% rise, a speed only seen during the pandemic when interest rates were at a historical low and credit flooded the banking sector. Although the interest rate has risen to a new record high, it still cannot stop the enthusiasm for buying houses in the market and the fact that no one is willing to sell their homes. The supply-demand gap reached a new high in May. So what we learned in May was interest rate and house price trends are not necessarily correlated. What's more important are the basic supply and demand factors and the debt ratio factors that we will discuss later. Then we all knew what happened in June. The housing market went up again. So let's take a moment to reflect on the trends of the Australian property market in the first half of the year. The collective behavior of home buyers signals a rebound from the bottom of the Australian property market, and the popularity of high-end properties indicates the soon-coming bull market. Some might still wonder, why are housing prices rising when interest rates and borrowing costs are increasing, loan capacity are decreasing, and the Australian economy is underperforming? Well, this confusion is very common among property investors. It's crucial to discuss the fundamental driving forces for house price increases. Simply put, whether house prices rise or fall comes down to residents' debt ratio. Let's first focus on the term residents. Residents refers to the population. In a country, state, city, or suburb, a surge in population leads to an increase in housing prices. Take current Australia, especially Sydney, Melbourne, Brisbane, and Perth, for example. A massive influx of immigrants fuels the rise of housing prices. Why? Well, there are more people buying houses. On the other hand, if a place experiences a drastic population decline, it is pointless to talk about property prices. Just think about the so-called ghost towns. Throughout 2022, Australia saw net immigration of 387,000, the highest on record. Western Australia and Queensland population grew by 2.3% and 2.2% respectively. Each state and territory saw a population increase. As predicted by the Treasury, Australia's net immigration will reach 400,000 this year, breaking the records once again. And what about the housing supply? It simply cannot catch up. Even before Australia opened its borders, the rental market was already tight, with rents beginning to rise. Big city rent has increased by at least 30% from the border open. and the sales market is experiencing similar phenomena. How could property prices fall with more buyers and the same number of sellers? Although the Australian economy isn't doing well, you must look at the state and territory levels. New South Wales is running a deficit, and Victoria is heavily in debt. Yet Perth, thanks to its iron ore exports, has been running a budget surplus for years, with a surplus of $3.3 billion last fiscal year. Brisbane, due to its coal exports, posted a surplus of $12.3 billion, which explains why New South Wales and Victoria have introduced additional property taxes for investors this year, while investors in Brisbane and Perth remain relatively relaxed. So at a national level, an increase in immigration and natural birth rates lead to a rise in housing demand, boosting the property market. Apart from overseas immigration and natural birth rates, interstate migration is another factor at the state level. Just considering this, every city in Australia is losing its population to Queensland, causing a population boom in the state, and thus the property price increase there. Let's now zoom in. Why would a suburb or local council area experience an increase in population? If it's an established suburb, factors like comfort of living, facilities, infrastructure, hospitals, schools, transport, and wage levels come into play. For developing suburbs, master planning and future comfortable living environments are essential to attract residents. So at this level, the population will always flow towards promising areas with comfortable living conditions and job opportunities, making it hard for property prices in these areas not to rise. The second half of the equation is the debt ratio, which refers to the financial leverage factor. Our real wages have stayed the same in Australia over the past decade or so, considering GBT and CPI. With recent high inflation, real wages have even decreased. So how can housing prices rise when people's real wealth is not increasing? Besides the population factor, the key is the financial leverage factor, or as I call it, the debt ratio. With fixed incomes, if people want to buy properties, they need to borrow more from the banks. With more money, competition for houses naturally drives prices up. Things like interest rate cuts, lower stress tests, credit creation, and even fiscal subsidies are all part of this debt ratio factor. So just think about this. Why did housing prices skyrocket during the pandemic when Australia closed its borders? The population barely grew and the GDP decreased. That's all due to the debt ratio factor. People leveraged themselves at extremely low interest rates to compete for houses, leading to a housing price surge not seen in decades. Another case in point is China. Why are housing prices plummeting so harshly when banks cut interest rates? Why aren't people buying houses? Well, firstly, China's population has started to decline. Fewer people means less need in dwellings. Apart from the first-tier cities, which still attract people, other second, third, and fourth-tier cities, house prices no longer relevant. Secondly, since 2009, people in China have been taking more and more leverage to buy houses. And now, the leverage is too high and cannot be higher, meaning no one can afford to service the bigger mortgage. Those with houses are burdened with debt, those without don't want to borrow money, and everyone wants to lie flat. The next 10 to 20 years will be an era of low desire, low consumption, and low leverage, similar to Japan over the past 30 years. So the fundamental factors driving housing price increases can be summed up in the phrase residence debt ratio. With that said, what would be the trend of the Australian property market in the second half of the year? What factors should we consider? Firstly, Australia's population will continue to grow, including immigrants, overseas students, and natural births. Wherever people go, the housing prices there will rise. And secondly, Australia's unemployment rate remains very low. Almost everyone has a job, which means a stable income. Even though the cost of living crisis will stay for a while, it is not to the extent that people cannot afford to repay their mortgage. They won't be forced to sell off properties at the same time. Thirdly, there's the lack of new housing supply. More buyers means more housing demand, and the supply just cannot keep up. Even if you purchase now, a new house will take 2 years to be constructed, so the shortage of housing supply will be there for at least 2 years, driving house prices up. Even though there are factors contributing to a rise in housing prices in the second half of the year, there are also some unfavorable factors to be aware of. Firstly, there's the so-called mortgage cliff. Those still holding low-interest mortgages will soon face a jump in the interest rate when the existing mortgage expires. From 2% to 6%, that's triple the interest payment. Next, many analysts predict that Australia will raise interest rates 1 to 2 times in the second half of the year, bringing the cash rate to around 4.6%. With such high interest, fewer people will enter the property market. The last point is the traditional spring real estate sales season, which increases supply and relieves upward pressure on prices. So the property market in the year's second half has both pressures and upward momentum. It would be best if you made your own judgment when purchasing. I made a detailed analysis in last week's live webinar. It is on my other channel's member page. Unfortunately, it was in Mandarin. If this English channel reaches 1,000 subscribers, I will also do a monthly webinar in English. With that said, I'd like to share 2 investment rules that I've been using for a long time. Number 1, real estate investment is risky, but only when you don't understand it. Number 2, never try to time the market. For most people, buying and holding for long-term growth is the best investment strategy. If you've made it this far, please give a like, subscribe, and share this video with your friends. Turn on the notification bell to watch new weekly videos, and follow me on social media at RealCoachAlex. Hope to see you soon. Have a good one.